What is a good bond fund versus a bad bond fund? And do the fees, the expense ratio, really matter? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, as many of our regulars know, Marcus and I are strong believers in buying and holding individual bonds to maturity because of these 3 C's here: more clarity, greater control, and lower cost. That said, there may be instances when an investor may want to go with a bond fund rather than individual bonds. Municipal and/or corporate bonds are 2 prime examples because they may require more time, effort, and money to properly understand. So in today's video, we're going to cover the 5 key bond fund indicators that should be able to help you get a first assessment of whether a bond fund is good or bad, depending on your personal situation. These bond fund indicators are the same ones that are used by the largest fixed income asset management companies, such as PIMCO and Franklin Templeton, and the largest ETF houses, such as BlackRock and State Street, as well as all the major brokerage houses that distribute both their own and third-party bond funds, such as Fidelity, Vanguard, and Schwab. And all of these companies will show these key bond fund indicators for their funds, both on their web pages and in the fund's prospectus. The first key bond fund indicator is a fund's total return. This is a fund's comprehensive historical performance over time and calculated by adding up the capital gains or losses plus the dividends and other income distributions to shareholders. In other words, the total return is based on both the development of the share price of the fund and the dividends distributed to its shareholders over a certain period of time. Total return numbers assume that dividends are immediately reinvested into the fund, and their net returns after fee and expenses. So they are a good starting point for comparing performance across different investment opportunities. Total returns are often shown both by calendar year, so for 2024, 2025, and so on, and on a trailing basis, meaning the total return you would have achieved had you invested exactly 1 year, 2 years, or 3 years ago, and so on, from the point of calculation. It's always important to look at a fund's total return over a longer time, not just the most recent quarter or even year. And of course, do remember that past performance is neither a guarantee nor indication of future results. Moving on now to the second bond fund indicator that you can use to evaluate a fund with, and that's the distribution yield. The distribution yield, as the name says, looks at distributed income only, how much cash an investor got paid over a certain period of time. This does not tell the whole story, of course, as it ignores capital gains and losses, essentially the development of the share price of a fund. But it can be a useful tool for getting a feeling for how much in cash flow an investor might expect from an investment. This perspective can be especially important when you're planning for retirement, and generating sufficient income may be one of your top concerns. The standard way for measuring cash distributions is the 30-day SEC yield. It is standardized across all funds and already deducts expenses, again, in order to make it comparable across different funds. The basis for the 30-day SEC yield is the income generated by the fund on its underlying portfolio, usually from interest and dividends, for the last 30 days, hence the 30-day in the name. This 30-day total income is then extrapolated to 1 year, multiplied by 12 to get to an annual rate, and divided by the last available net asset value of the fund at the time of the calculation. This sounds complicated, but in essence, what the 30-day SEC yield does is try to estimate the cash flow that the fund will generate for its shareholders over the next year if everything stays the same as the previous 30 days, and then divides this number by the price an investor would have to pay right now to buy a share. So, if payouts stay at the current level, a 5% 30-day SEC yield would mean that an investment of $100 today should return 5%, or $5, in cash to the shareholder over the next 12 months. There are some other distribution yield measurements out there as well, such as what independent investment research firm Morningstar calls the trailing 12-month yield, or TTM. This is the same basic concept as the 30-day SEC yield, but it takes the actual distributions, the cash payouts from the last full year as the basis for its calculation, hence the trailing 12 months in the name. The argument for taking a full year as the basis is that it might be more representative than just the latest 30 days, especially in volatile circumstances. Whereas the proponents of the 30-day SEC yield would argue that a year may be a long time in financial markets, and the numbers may be more out of sync with the current environment than the fresher last 30-day view. We don't have a strong opinion here, but in our mind, it can't hurt looking at both the 30-day SEC yield and the Morningstar trailing 12-month yield. And in many cases, for example, for relatively stable funds, they should be similar anyway. That said, you should always remember two things when looking at distribution yields. First, just like for total return, past performance is not indicative of future results or outcomes. A distribution yield is an extrapolation, an estimate based on past performance, and not a guarantee in any shape or form. Things can and do change all the time with funds. The way they're constructed, bond funds are just not set up like individual bonds with their fixed interest payments and maturity schedules. And second, to say it once more, a distribution yield shows a part of the picture only and should always be considered in combination with the comprehensive total return, which includes capital gains and losses as well, and other key bond fund performance indicators. And if you're enjoying this video so far and want to learn more about bond basics and how to build a bond portfolio while rates are still attractive, remember to take advantage of our first blowout sale of the year. There's still a few days left to save. Use coupon code INCOME2026 to take $100 off of our popular bond course bundle, which includes our foundational level bond beginners course, as well as our intermediate level bond masters course. The coupon code INCOME2026 is valid until midnight Eastern Time on Sunday, March 1st. And if you already understand some of the basics of bond investing, then come join our VIP investment club, where our members have daily conversations with me, Marcus, and one another on the best rates and what they're investing in right now for higher yields. Here's just one of the many testimonials from our long-standing VIP members. I learn a lot from Jen and Marcus. I started listening to Jen 3 to 4 years ago on YouTube. They're very helpful. I don't randomly trust people just because of something online, but you can't listen to Jen and not trust that she is an expert and wants her subscribers to be successful. Thank you, Jen and Marcus. Marcus and I would also like to say thank you to our members and Diamond NestEgg community for always being there to listen and learn more. I've included the links for our VIP investment club and bond courses below this video for your convenience. For now, let's keep going with our key bond fund indicators. Up next, as number 3, we have a fund's expense ratio. The expense ratio is what a fund typically charges investors to manage the fund, calculated as a percentage of fund assets. A fund's expense ratio is determined annually and should capture all charges that will be borne by the fund's investors. All else being equal, the higher a fund's expense ratio, the more of a drag it may be on fund performance and the growth of your overall portfolio. So it's something you definitely want to take into consideration when selecting a bond fund. Also note that the expense ratios for many passively managed ETFs, as well as some newer index funds, are lower and sometimes much lower than for many more traditional actively managed funds. That said, and as we mentioned earlier, both total return numbers and distribution yield numbers already deduct the expenses. This means that the expense ratio alone, while still good to know, only tells you the cost part of the story. If you evaluate a fund's performance, you also need to look at the returns it produced and look at the resulting total return and or distribution yields that we talked about already. The fourth key indicator that you can use to evaluate a bond fund with, its average maturity. This refers to the weighted average of all the maturities of the bonds held by a fund. Generally speaking, the longer the average maturity, the more sensitive the fund tends to be to interest rate and market changes, meaning the bond fund's share price will move more strongly in either direction, up or down. And the longer the average maturity, the harder it may also be for a fund to ride out any market volatility. And finally, we have a fund's duration, which is generally closely correlated with the average maturity. Duration estimates how much a bond's price fluctuates with changes in interest rates. As a general rule, for every 1% increase or decrease in interest rates, a bond's price will change approximately 1% in the opposite direction for every year of duration. Yields up, price down, and vice versa. For example, if a bond has a duration of 5 years and interest rates increase by 1%, the bond's price will decline by approximately 5%, 5 times the 1% change per year of duration. And if a bond has the same duration of 5 years and interest rates fall by 1%, the bond's price will increase by approximately 5%. So these are 5 key bond fund indicators that we use here at Diamond NestEgg when we first start our evaluation process. But they're by no means exhaustive. If you enjoyed today's video and learned something new and want to keep learning to gain the know-how and confidence you need to manage your own portfolio, use coupon code INCOME2026 to take $100 off of our popular bond course bundle and VIP Investment Club membership before midnight Eastern Time on Sunday, March 1st. Our bond courses are the first step in learning all about fundamental Treasury agency, corporate, and municipal bond concepts and how to build a bond portfolio. And our VIP Investment Club allows you to advance beyond that and dive deeper with me, Marcus, and our other members. Popular conversations in recent weeks have covered everything from bonds to mortgage REITs, preferred stocks, international investing, and precious metals. Basically, whatever our VIP members have as top of mind topics for the day and or week. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button or this Bond Course Bundle button to learn more. I've also linked everything below this video for you. All right, Diamond NestEgg members, super savers, and course fans, see you again very soon with more brand new wealth building content for your financial journey.